Hello and welcome to One Degree Advisors, where we help families cut through the noise to make confident financial decisions. You know, Alex, a lot of retiree clients of ours, they bring up this idea of interest rates being at historic lows.
Yep.
It's great for borrowers because, if you have a mortgage, man, you're getting a really good deal.
A lot of people were recommending refinancing. Yes.
Yes,
Well,
it's good.
borrowing is very cheap right now.
But the other concern, the other side of it is for savers, it's not such a good deal. If you have money in the bank, and then a lot of our retiree clients are concerned, to just people that are out there with bonds. So talk about the problem that we may experience with bonds, or at least the potential for it.
Yeah. So again, interest rates have an impact, especially when we're talking about retirement planning. And let's think specifically about retirees. They're older, they're probably gearing up with more conservative investments because they're preparing for retirement and drawing down that money.
Yeah.
So an increase in interest rates can be a concern, right? Let's just take an example, right? The current 10-year treasury is paying less than 1%. It's the lowest it's been in the past 20 years. And again, I think in the early 80s, the 10-year treasury was paying a hair over 15%. So this is quite a swing, going from a hair over 15 to now sub 1%.
So you had decades of interest rates coming down, which was great for bonds, and now we're on the other side of that.
Exactly. So now it means, okay, intuitively, what does this mean? If bond rates continue to come down, where's the only other direction they can go? I mean, they might be able to go down a little bit more. We've been saying this for a while, they're going to go up, but they haven't. But intuitively, the thought process is they will come up. And when interest rates do come up, that's not very good for bonds.
Yeah. Now, to pick up on your point there too, we have been talking about, hey, interest rates are going to rise for the last 10 years, and they really haven't. So bonds have still met that objective of helping to reduce risk in an investment portfolio and providing some return there.
Yeah.
So how do we address in an investment portfolio? We have some concern around bonds. What are some things that we can do?
Absolutely. So I'll bring up one thing I know that we talk about quite frequently with folks, which is just diversification of strategies. It's that age-old concept of don't put all your eggs into one basket. So, you can invest in things that aren't so closely tied to traditional stocks and bonds. You can invest in, more real assets like real estate or commodities, right? That provides a diversification benefit that you can't just get out of traditional stocks and bonds. The other thing that you can do is you can overlay maybe more of a tactical risk management strategy. So it allows you, again, the goal is to take on maybe a little bit more risk than you traditionally would, but because you've overlaid more of a tactical and flexible strategy on it, the goal is to avoid major drawdowns. Right. So again, having a bit, you still want your core portfolio to be stocks and bonds, but adding on a little bit of diversification can help in these really uncertain times when we're going, what are interest rates going to do? They keep heading lower and lower and lower. At some point, they should come up.
Yeah,
that's one thing.
Well, let's talk about, because we're not advocating in most situations, everybody's unique, that you totally get rid of bonds.
Yeah.
But what are the bond characteristics that we should look at?
Yeah. So really two things, right? If I had to summarize it, is short-term, tilt towards the short-term bonds and tilt towards higher quality bonds. So not like junk bonds or things like that. And if I had to summarize it, it's in essence, the shorter the maturity, it lowers your interest rate risk. So as a shorter term bond matures, it'll reinvest into the current interest rates, which again should help decrease that interest rate risk. But we have to think about this within the context of the overall portfolio construction and philosophy, which is bonds are designed to help take risk off the table, help lower that risk, and we get our long-term growth out of stocks. Okay, so when we think about it within that context, it gives us a perspective to say, I want to look at my bonds, maybe short-term, high quality, really provide that stability that I'm looking for. Right. And in the long term, my stocks are going to give me the growth that I need to preserve my purchasing power, make sure, I quote, don't run out of money.
Yeah, and I'll just add on to that, the other wise thing can be to have a cash reserve for just savings. Okay, so then number 3, and this where you have to be careful though, is increasing stock exposure, because people are
just like you said, you have to be careful with this. And I know it's kind of funny because we just came out of March where everyone was getting conservative, and now we're saying long-term folks might have to take on a little bit more risk than they traditionally would. And this is just simply because bonds may not produce the same level of returns as they have in the past, especially if we head into a rising interest rate environment. So this is why we're just huge advocates for financial planning. It's why we do financial planning for our clients, because each person is different. You can't look at someone and say, oh, you're in your 60s, you get a 60-40 portfolio. There's a lot of talk about the 60-40 portfolio is dead. Now, whether or not that's actually true, that's a different story. But the point is that you can't just look at someone's age and some basic risk metrics and go, there you go, that's what you get. Each person has to be looked at within the unique context of their plan. What do they need? What are their goals, priorities? And then how do we build a customized investment structure around those things?
Yeah, so that uniqueness really can't be understated. There's lots of factors to consider in putting a retirement investment plan together. This is not really meant to be investment advice, it's just considerations.
Exactly.
So these are the types of things that we do help families with, we help retirees with. If you'd like to talk with us more about aligning your retirement investment portfolio with your financial plan, go to our website, you can schedule a call. We would love to talk with you.